It's Monday, December 29th, and we are witnessing the death of the old financial order in real time. Silver is currently hovering in the $88 range, and the banks are in a total state of emergency. Mainstream media is calling it a glitch, but we know the truth. A major clearing member has failed, and the whale is dead. The metal that central banks tried to suppress for decades is finally breaking free, and the financial world is watching in absolute shock as the price barrier that seemed impossible just weeks ago is now dissolving before our eyes. In this video, we break down the liquidation event, the industrial panic from Tesla and Samsung, and why $78 is the last cheap entry you will ever see. Silver, the white metal that has lived in the shadow of gold for so long, is now trading in the $78 per ounce range, representing a move so violent that it has left institutional investors scrambling to understand what just happened. This is not a typical market rally where prices drift higher over months or years, but rather a structural break in the very foundation of how this metal has been priced for the past 4 decades. The weekend saw prices briefly touch levels above $80 per ounce in Asian trading sessions, marking a moment that many believed would never arrive in their lifetimes. What we are witnessing is not simply a price increase, but the unwinding of a suppression mechanism that has kept silver artificially constrained while nearly every other asset class inflated to record levels. The paper markets that have dominated silver pricing for years are now facing a reckoning as physical demand overwhelms the available supply in vaults across London, New York, and Singapore. To understand the magnitude of this event, consider that just 3 months ago, in late September 2025, silver was trading in the low 30s per ounce. The move from $30 to $78 represents a gain of more than 130% in less than 100 days. This kind of velocity is typically seen in speculative cryptocurrencies or small-cap technology stocks, not in a commodity market with a history stretching back thousands of years. The London Bullion Market Association, which serves as the global hub for precious metals trading, is reportedly facing unprecedented stress as demands for physical delivery have exceeded the available inventory in their vault network. Multiple sources within the trading community have indicated that certain large institutional participants are struggling to source the physical metal needed to satisfy contracts that were written when silver was trading below $40 per ounce. This shortage is not theoretical or projected. It is happening right now in real time as dealers and industrial users compete for every available ounce. Major online precious metals dealers, including APMEX, JM Bullion, and SD Bullion, have experienced what they are calling site maintenance or inventory updates. But the reality is that their shelves have been cleared by a buying frenzy unlike anything seen since the financial crisis of 2008. The premiums being charged for physical silver coins and bars have exploded, with some sovereign mints seeing premiums of $20 to $30 above the spot price quoted on exchanges. When you see a spot price of $78 but have to pay $110 to actually obtain a 1-ounce American Silver Eagle coin, you begin to understand that the paper price and the physical price have diverged into 2 separate markets. Gold, the larger and more established precious metal, is currently trading at $4,534 per ounce, a level that would have seemed absurd to most investors just 5 years ago. The historic ratio between gold and silver prices has traditionally hovered around 15 to 1, meaning that throughout much of human history, 1 ounce of gold would purchase approximately 15 ounces of silver. If we apply that ratio to today's gold price, silver should theoretically be trading at over $300 per ounce. The fact that silver sits at $78 indicates that even after this explosive rally, the metal remains undervalued relative to its monetary cousin. The ratio as of this Monday stands at approximately 58 to 1, still far above the historical average, and suggesting that silver has substantial room to continue its catch-up trade. Algorithmic trading systems that monitor these relationships are now firing buy signals across the commodities complex as they recognize the statistical anomaly. These computer-driven systems do not care about emotions or narratives. They simply identify pricing inefficiencies and exploit them with enormous capital, creating the kind of momentum that can drive prices into parabolic territory. The Chicago Mercantile Exchange, which operates the largest futures market for silver in the world, has implemented multiple trading halts over the past week as prices hit limit-up restrictions. These circuit breakers exist to prevent markets from moving too quickly and creating disorderly conditions, but they also trap traders who need to exit positions or hedge exposure. When a market goes limit-up, it means that buyers are so aggressive that no sellers can be found at any reasonable price within the allowed trading band. The market effectively freezes, and the pressure builds like water behind a dam until the next trading session opens and the surge continues. Reports emerging from clearinghouses in both London and Singapore suggest that at least one major clearing member, a bank or financial institution responsible for guaranteeing trades, has missed a margin call related to short positions in silver. When an entity sells silver futures contracts without owning the physical metal, they are betting that prices will decline. As prices instead explode higher, These short sellers face unlimited theoretical losses and must post additional collateral called margin to maintain their positions. If they cannot meet the margin call, they face forced liquidation, meaning their positions are closed at market prices regardless of the loss incurred. This forced liquidation is what creates the feedback loop that drives prices into the stratosphere. As short positions are bought back to close them out, the buying pressure pushes prices even higher, which triggers more margin calls, which forces more buying, and the cycle accelerates. This is the exact mechanism that caused the nickel market to break in March of 2022, when prices went from $30,000 per ton to over $100,000 per ton in a matter of hours. The London Metal Exchange was forced to cancel trades and shut down the market to prevent the complete destruction of several major banks. The same dynamic is now playing out in silver, but the scale is even larger because silver is held by millions of retail investors, industrial users, and central banks around the world. The failure of one clearing member does not simply affect that institution, it creates contagion throughout the entire financial system. Other banks and clearinghouses are required to step in and cover the losses through a mutualized default fund, effectively socializing the damage across the entire industry. This is how a problem in one corner of the commodities market can metastasize into a systemic crisis that requires central bank intervention.
Hello friends, welcome back to my new video and my channel. So friend, it is Monday, December 29 December, and we are witnessing the death of all financial order in real time. Silver is currently hovering in the 88th range, and the banks are in the total state of emergency. Mainstream media is calling it a glitch, but we know the truth. A major clearing member has failed, and the wall is dead. The metal debt central banks try to suppress for decides it is finally breaks free, and the financial world is watching and absolute shocks as the price barrier that cement impossible just weeks ago is now dissolving before our ears. This is a very important video. In this video, we break down the liquidation event, the industrial panic from Tesla and Samsung, and win and why $78 in the last cheap entry you will never see. Silver, the wet metal that is living in the shadow of gold for so long, is now trading in the $78 per ounce range. So, friend, this is very important banking. This is very important, uh, informative video. So, please like this video and subscribe my channel. Thank you so much.